workshops, and so you should be familiar with the Health Coverage Project. It's a joint initiative of the Economic Progress Institute and Rhode Island Kids Count, and we're funded by the Robert Wood Johnson Foundation. Our goal is to help Rhode Islanders know about affordable health coverage options, many of which were made available through the passage of the Affordable Care Act, and also to help Rhode Islanders know how to enroll in and keep coverage, and today to know about their tax responsibilities in relation to the Affordable Care Act. We are very pleased to have Carson Colmar here with us today from HealthSource RI to present about income taxes and the Affordable Care Act. And also helping with the webinar today are Jill Beckwith, the Deputy Director of Rhode Island Kids Count, Jim Beasley, the Policy Analyst at Rhode Island Kids Count, Linda Katz, the Policy Director at the Economic Progress Institute, Lindsay Lang, Kathy Meza, Meg Ivitz, Noah Zimmerman from HealthSource RI. So thank you all. So our goals for today are to answer some of the questions that we posed in our invitation, to understand for HealthSource RI customers who must and should file differently this year for their taxes, where they can go for help, and then what the exemptions are from the requirement that everyone must have health insurance coverage in 2014, and how they claim those exemptions. We know that many different types of organizations are on the call today, and people will have different levels of knowledge. We are assuming that folks have a basic understanding about HealthSource Rhode Island and eligibility to purchase coverage with tax credits, but we know that this topic is complicated and can be confusing. We will have other materials posted on our website later, and there will also be a recording, and the slides will also be posted. Just a few housekeeping points. Everyone is on mute today. If you have a question for Carson and HealthSource RI, please type it in the box on the right-hand side, and we'll be taking breaks throughout the presentation to answer those questions. And if you have a housekeeping question for me, you can also enter it in the box on the right-hand side. So with that, we will begin. Carson, take it away.
Great. Thanks so much, Rachel. And thanks to everybody for joining us today. I imagine that, as Rachel was mentioning, people will definitely have some questions. So I think that probably our best approach is going to be we're going to go through different sections. And at the end of each section, we can stop and take a few minutes to answer any questions in that particular section. So we're really going to focus on 4 key considerations today. And those are, some of these are going to be really familiar to you already, but we're going to look at all of the people, knowing that everybody needed to have health care for 2014 and what that will mean for everybody, and specifically Rhode Islanders. We're also going to look at how to help people who didn't have coverage this year and what that will mean for them. We're going to take a minute to look at exemptions, because we will have some customers who fall into the category, or non-customers perhaps, who fall into the category of being eligible for an exemption and therefore maybe not needing to pay a penalty if they don't have coverage. And then we're also going to look at the tax credit and what that means for reconciliation, which will need to happen during the filing of the 2014 income taxes. So as you're all probably familiar with, starting January 1st of 2014, the ACA mandated that all people needed to have health insurance coverage. This is called the Individual Shared Responsibility Provision, sometimes referred to as the individual mandate, and it generally applies to everybody, whether children, adults under age 65, as well as adults over age 65. For a vast majority of the people, of tax filers, it's really going to be a simple process. Essentially, they're going to be checking a box saying that they had coverage. They will not have any forms that they need to do in addition to that, and no further action will be required. So we want to look and make sure that we understand what we mean when we talk about minimum essential coverage. That's really what the ACA mandates. So there are a number of ways that somebody could obtain minimum MEC or minimum essential coverage, including Medicaid, CHIP, Medicare, and TRICARE, as well as employer-sponsored insurance. A number of the people in Rhode Island will likely fall under the employer-sponsored coverage. But other ways that they could have obtained MEC this year were through HealthSource RI, or if they went directly to the carriers and purchased qualified health plans that way. There are some grandfathered health plans that will qualify for MEC. But for a chart, if anybody's asking questions or concerned about whether or not they have coverage and their coverage is considered to be MEC, they can certainly go to the link here. And again, as Rachel mentioned, everybody will have access to this presentation after the fact. So you can certainly come back and get any email addresses or any websites that you need. So as I mentioned before, it's really going to be very straightforward for a number of people. They're basically on their 1040 going to be checking off that they had full year coverage. If anybody did not have minimum essential coverage, you can see here for each month of the year, then they're going to need to claim a coverage exemption or calculate what their responsibility is for paying the shared responsibility payment. Also, some people refer to it as the penalty. So as I mentioned, the penalty, I'm sure a lot of people have been, if they haven't asked already, are starting to wonder if they didn't have insurance, what will that mean for them? And so we want to make sure that we're really clear that if somebody didn't have insurance, their responsibility is going to be that they will need to pay either 1% of their household income or $95 per adult and $47.50 per child, whichever is the greater number. I think that the focus this year was really on, the penalty is $95, and it wasn't broken out very clearly for people, or people weren't really aware of what that meant. So we want to make sure that people are pretty clear on what that means. It is computed on a monthly basis. So for example, if somebody had coverage for June through December, but wasn't covered for the first 6 months of the year, they wouldn't have to pay the full penalty for 12 months. They'd pay a prorated amount for any months that they did not have coverage. It is a capped amount, and that is dependent on the specific person, and we'll get into that in a minute. And actually, if somebody is covered for at least one day of the month, then they're considered to have been covered for that entire month. So if somebody didn't have coverage for an entire month, maybe of a fourth month, and we'll get into what that means in a minute, then they may not have to pay a penalty. And certainly there is a clause saying that there's a short coverage gap allowed under exemptions, so it's a gap of less than 3 months, and we'll look a little bit more specifically at that in a minute. Although we don't want to focus too much right now on filing taxes for 2015, we thought it was a really good idea to just talk about what it will mean for customers who choose not to have coverage in 2015 in terms of the penalty, because it's not going to stay the same as it was for 2014. So when people are filing taxes for 2015, if they did not have coverage during that year, then they're going to have to pay the greater of either 2% of their household income, or $325 per adult, $162.50 per child, so whichever is greater of those two amounts. So there's a big jump in the penalty for between the 2014 tax filing year and the 2015 tax filing year. And really the reason we want people to understand this now is because we're still in open enrollment until February 15th. So we definitely have time to get to people and explain to them the importance of being able to be covered or having health coverage. And also have them know that if they choose not to sign up during the open enrollment, unless they have a qualifying event for a special enrollment period after February 15th, they will not be able to obtain coverage through us. We also want to make sure that they understand what that penalty will be next year, especially if somebody is thinking that they want to drop coverage for 2015. Some people may say, well, I never used it in 2014. I'd rather just pay the penalty. They need to understand what that would mean for them. And again, the penalties will increase for the year 2016 by quite a bit as well. And then beyond that, it's going to be based on inflation. The increases won't compound quite as much. So I think that we could probably take a minute to take any questions.
So far we don't have any questions entered. So why don't we keep going, and if people have questions about that section, we can always take a break and go back.
Great. Okay. Thanks. All right. So let's move on to talk a little bit about the exemptions. Let's talk about what exemptions are and how somebody could apply for one if they think that they're eligible. There are a number of different types of exemptions that people could be eligible for. I'm not going to necessarily go through everything that's listed here. And one caveat I will say is that because Rhode Island is a Medicaid expansion state, some of the things that you might see in other states where they didn't adopt Medicaid expansion may not be as applicable here. We won't see probably as many people that would fall into those categories. So the first one here is that insurance is unaffordable. So if a customer comes to us and says that the lowest cost bronze plan available to them is more than 8% of their household income, that would qualify them for an exemption. Also, if you don't have to file a tax return because your income is too low, keep in mind that there's a little bit of a caveat here for people who did have coverage and received tax credits, but we'll get back to that in a minute. I just want to make sure people are not confusing those two things. If you're uninsured for less than 3 months, as I mentioned before, and if you qualify for a hardship exemption, and we'll talk a little bit about that in a minute. I had a question come in. I'm just going to stop for a second about the penalty. And the question was whether or not the penalty would be broken down by month for 2015 the way it's prorated in 2014, and the answer is yes. If a customer had coverage certain months of the year but not other months of the year, they would only be responsible for the penalty for the months that they did not have coverage. So good question. Okay, we've got another one coming in. Hold on. The 8%. Yeah. Okay, so we have a question that we anticipated might come up about the difference between the 8% that I just mentioned for exemptions and the 9.5% that you're probably much more familiar with. So the difference really is tax credits. So for somebody who is has coverage offered to them through an employer, and they apply to HealthSource RI and are able to determine that the coverage offered to them through their employer is more than 9.5% of their income, then they are eligible to purchase insurance through HealthSource RI, and they are able to get tax credits towards that. When we talk about the 8%, what we're talking about is, as I mentioned before, if any coverage offered to somebody through the exchange, and this isn't about having tax credits, this is about if any coverage is offered to them the cheapest coverage that's offered to them is more than 8% of their household income, then they are exempt from having to purchase insurance. So the difference is really the 9.5% tells us whether or not a customer is able to get APTCs to help offset the cost of the insurance that they purchase, and the 8% is about whether or not they're exempt from having to purchase insurance altogether. Okay. All right, so we will get back to talking about exemptions. Certainly, if you have more questions, feel free to keep sending them in. As a lot of you probably know, if people are members of a federally recognized tribe, or they're eligible for services through Indian Health Service Provider, then they could be exempt from having to have insurance. We have recognized healthcare sharing ministries, members of religious sects with religious objections to insurance, including Social Security and Medicare, for incarcerated people, and also for people who are not lawfully present. They can all apply for the exemption. We kind of already covered this, but here's an example of the 8% that we were talking about before. So if a person's household income in 2014 was about $15,000, if their cost of their employer-sponsored coverage was $1,500, and the lowest cost, so that would be considered unaffordable for them, but also the lowest cost bronze plan available was $1,300. That would be the plan offered through the exchange. In both of those cases, the options, they exceed 8% of the household income, and therefore they're eligible for an exemption from the penalty, which means that they don't have to purchase insurance. This is just a chart to show you kind of the income filing thresholds for people, and because we want to make sure that people who receive tax credits did file their taxes, but in terms of people who are exempt, if their income is below the filing threshold, they do not need to do anything to get the exemption. They may still want to file their tax return. There was an interesting article this morning in the paper about this. But they may still want to file a tax return to get that earned income tax credit, which is something that they may be eligible for. And so certainly strongly encourage people to do that. as an option for them. But if you're interested in learning more about the chart, then you can go to the website that's here, and again, you'll be receiving the slides after the presentation is over. We also have hardship exemptions, and there are a number of categories that would fall under this. I won't necessarily go through every single one of them, but they include being homeless or being evicted, having a shut-off notice from a utility company, etc. One thing to be really clear about, sorry, I'm going to flip through this slide quickly because it's just more examples, but one thing to be really clear about with the hardship exemptions is that they apply in the month of the hardship and the month before and the month after the hardship. So they don't necessarily, if somebody had was evicted maybe in February and they didn't obtain insurance for the entire year, then that exemption won't necessarily apply for the entire year. And they should apply for the exemption by submitting an application through HealthSource RI. They can do that through the HealthSource RI, the website. To apply for an exemption, there are a couple of different ways, and it's going to depend on the type of exemption that people are applying for, and that'll dictate how they should fill out the application. So for people who are applying for the hardship or a membership in a recognized religious sect whose members object to insurance, they can complete and submit the exemption application form. We have the word UHIP here. That's probably an unfamiliar term to most of you. That's basically, it's through people's HealthSource RI account. If somebody is applying based on coverage being unaffordable, incarceration, or membership in a healthcare sharing ministry, they can either file the exemption when they fill out their 2014 tax returns, or they can complete and submit the exemption application through their HealthSource RI account. If they're applying for an exemption based on a membership in a federally recognized tribe, or if they're eligible for services through an Indian healthcare provider, they can complete and submit the exemption application again on HealthSource RI. They should submit documentation of membership in that tribe and file a federal income tax return using the IRS health coverage exemption form, either through self-attestation or providing an exemption certificate number. And I think, oh, wait, one more slide on this, sorry. So for customers who want to come through, or for people who want to come through and file for an exemption, they should log into, again, the HealthSource RI account. You may be familiar with these screens. For anybody who does know and has been in a home dashboard for a customer account, you're probably more familiar with where I'm pointing my mouse right now, the account home. But across the top, there are different tabs available. And the Tasks tab is where somebody would go if they wanted to apply for an exemption. And you can see down at the bottom of the page here, they would click on Apply for Exemption, and it will walk them through the screens to lead them how to file the exemption they're looking for. So I think before we move on to talk about tax credits, we can stop and take, I think we have a couple of questions coming in. Okay.
Yes, so we have a question about the 8% income amount. Let's see, I just lost it, sorry. Okay. So just give us 1 second. We're going to.
Okay, so the question is, will enrollment up to the February 15th be retroactive until January 1st, 2015, both for coverage and for 2015 IRS filing? The answer is no, for the 1-month cap. And when is payment due for coverage retroactive to January 1st? That's a great question. That's a very timely question. Today, I know this is a little bit off topic here, but we can certainly address it. So there was a the payment due date for people who were asking for January 1st or signed up for January 1st coverage. The deadline to pay for that coverage is actually today, January 15th. If customers do not pay by today, then they will need to enroll for February 1st and pay by the 23rd of January in order for their February 1st coverage. So that's a good question. That isn't necessarily totally related, but I'm glad it was asked. Right. Yeah. Oh, and somebody was just making a great point that if they do miss January, they will only they'll only have missed 1 month. So as I was saying before, we're still in open enrollment, so we really want to encourage people to come in and apply for coverage for starting February 1st, because remember that exemption, there's an exemption for people who have less than a 1 month gap in, have less than a 3 month gap in coverage. Household income, okay. Yeah, okay. So the next question is whether household income is their net or gross. It is gross. There is a little bit of confusion because we do use the word net sometimes on the application, and what we mean when we say net is that if anybody's income minus any deductions they may take. So not net as people think about when they get in their paycheck, what they bring home from their paycheck. It's net in terms of what's your total gross income minus any deductions. And is there a list of hardship exemptions available somewhere for us to refer to? You guys will receive a copy of this, or you'll get an email where you can link to a copy of this presentation, and the hardship exemptions are there. And we've got a whole bunch of resources at the end of the presentation. So I think we have another question that I think we're still researching.
So, Carson, there's just a couple others following up on the exemptions. Someone is asking if you have to file the exemption while in the hardship situation, or can it be done within the year?
So you can do it within the year. However, it won't necessarily, you can't, if you wait and expect that it's going to cover the entire year, it won't necessarily cover the entire year, depending on the exemption.
And then a follow-up question about the penalty for being uninsured for 3 months. Is it less than 3 months uninsured, or is it 3 months uninsured?
So it is less than 3 months, which remember I said before, if you have coverage for 1 day in a month, that would count as being covered for the entire month. So you could go, 2 months plus almost the entire next month without coverage if you were able to gain coverage for 1 day in a month.
And that exemption is true until you gain 15 months.
Right. Yeah. So I wanted to just clarify that question. Sorry, Rachel. I know you asked another one, but that customers need to make sure that they apply for coverage by February 15th, because once that it's for effective date March 1st, because once March hits, then there's no more opportunity unless somebody has a qualifying event for a special enrollment period. But then it would be more than 3 months that they didn't have coverage, and they would have to pay that penalty for those 3 months. And sorry, Rachel, was there another question?
Yes. So the exemption is still true for 2015, the same.
Yep. So the rules, the same exemption rules apply. The difference between 2014 and 2015 is the amount of the penalty.
Okay. And then in terms of how to apply for exemption, can a person walk in to the center and do it, or can they only do it online?
They can absolutely come into the center to get assistance with it. It's in their application, so a customer service rep would assist them by going into their account with them. But if they're not comfortable doing it on their own, they can definitely come in and do that with somebody at the call center.
Okay, and then one more. What happens if the hardship lasts for more than 1 month?
If the hardship lasts for more than 1 month. Sorry, we have the experts in the room who are giving us the information. Yep. Right. Yeah. So generally speaking, the hardship exemption is for the month in which it occurs, the month before, and the month after. Obviously, if it's occurring for multiple months, the actual hardship itself, then you should be covered for those months for the exemption. Yeah.
Okay, and then so I think there's some confusion about for 2015 you have to be covered for the entire year or to avoid the penalty.
So the same rules apply for 2015. So if you go now we're in 2015. I keep saying next year, but in the year 2015, if a customer doesn't have coverage, say for January and February, they apply by February 12th and get coverage, but not to start until March, they should be exempt from having to pay the penalty for January and February, because that is less than 3 months. So the same rules for the exemptions do apply for 2015. And it is a one-time exemption. So in other words, you can't say, okay, I'm not going to have coverage in January and February. I'm going to have it in March, April, and May, and then June, July, I'm going to go without it and somehow get back on in August. You can't kind of double dip that way. It's a one-time in a year exemption.
And then one final question.
Sure.
If a person loses coverage because of a system error, are they liable to pay the penalty?
So the question was whether if somebody loses coverage because of a system error, would they be exempt from the penalty?
They should be exempt from the penalty, and we should get them back.
Yeah. So if a customer finds themselves in this situation, they need to make sure to contact HealthSource RI, and we will work with them to make sure that we can reflect that they either had coverage or a reason why they didn't have coverage.
Okay, I'm seeing some questions that people can't understand, some of the questions being asked. So if you will just, we will post the questions and the answers when we send out a follow-up email. If you want to type into the email whether it's the person that you can't understand or whether it's me, Rachel, that you can understand, that would also be helpful. So I'll have someone repeat the question in the future. Okay, with that, Carson, you want to?
Absolutely. We can move on. And I will say, this is really, really complicated stuff, so I totally understand why some of these questions may not be clear, and maybe some of the answers may not be clear. But we will do our best to make sure that in writing, they will be a lot clearer. All right, so let's move on to talk about the tax credit. As a quick refresher, I'm sure a majority of you, if not all of you, are really familiar with the tax credit and how it works. But it is a refundable tax credit to help eligible individuals and families pay for health insurance. If customers in Rhode Island were interested in obtaining it, they had to apply through HealthSource RI. They couldn't get it if they went directly to a carrier. And they had two options, essentially. One was either they could take the premium tax credit to help offset their monthly costs. And when I say they could take it, what I really mean is they could choose to have it paid to the carrier to offset the amount that they would have to be responsible for their premium. Or they could choose not to take it, and when they file their taxes for 2014, they could obtain it as a refund or offset the amount that they might have otherwise owed to the IRS. The choice is really up to the person, the customer, and they also had the option and continue to have the option to take a portion of it up front and then take the rest of it in a refund when they file their taxes. And that's going to be true going forward, so that's true for 2015 and will be true for future years as well. One thing that I think is probably APTC may be the acronym that most people are familiar with. So we just wanted to make sure that people understood what we were talking about when we say APTC versus PTC. And PTC is what the IRS uses when they talk about the premium tax credit. The difference is the APTC means the advanced premium tax credit, which means it's taken in advance. So on the previous slide, we talked about the two ways customers could take that credit. And the first way being that they could take it throughout the year on a monthly basis. So that would be, it was advanced to customers. Whereas the premium tax credit is calculated after the policy year is over during the tax filing process, and it's based on the final income and household size. Something to keep in mind about the advanced premium tax credit is that it was based on an estimation for what somebody would make in a year. So we're gonna focus on that a little bit on a future slide, but I just want to make sure to make that distinction. In order to be eligible for a tax credit, the customers must be an applicable taxpayer, so they would fall between 100 and 400 FPLs, depending on their family size. They can't be claimed as a dependent on somebody else's tax return. And this is an important one that I'm not sure everybody's totally clear on. If a customer is married and they took a tax credit or want to apply for a tax credit, they have to file jointly. They cannot opt to be married filing separately. If they do that, then they are not eligible for tax credit. Additionally, they have to have had a coverage month. Obviously, we're not going to pay, a tax credit is not going to be paid out to a customer who didn't have any coverage for any given month. So if they're enrolled in a QHP, the Qualified Health Plans through HealthSource RI, they can't be eligible for minimum essential coverage elsewhere, so that employer-sponsored insurance, if it's seen to be affordable, then they're not eligible to have taken tax credits. And they have to have paid their premiums for each month. So there are some key considerations to keep in mind. Again, the tax credits are optional, and they're optional to take them in advance, so customers did not have to do that. Every customer who did take advanced tax credits is going to have to reconcile, and payments may be required. This next one is a really important point to understand, that the differences between the advanced credit payments and final credits are very likely. So we are expecting that a majority of our customers will see that there's at least some difference between the APTCs that they receive during the year and when they reconcile their taxes, the amount that they should have received. They may have gotten more than they should have. They may have gotten less than they should have. It's incredibly difficult to estimate in January, February, March exactly to the dollar how much money you're going to be making in a year. So unless you were able to do that down to the penny, there's going to be at least somewhat of a difference. And a tax return, changes in circumstances can also affect the PTC amount. We're going to talk more about that. And a tax return must be filed, even if a taxpayer is otherwise exempt from filing. So we talked about the exemptions before if you were too low. But if you took a tax credit, you absolutely have to file a tax return. It needs to be reconciled against something. This is just an overview for you. Again, you're going to get these slides, so you'll be able to see this, and you probably are all familiar with the income limits based on the 2013 federal poverty levels. So we talked a little bit, or I mentioned before, that changes in circumstance, how that can affect credit. So eligibility for a PTC, even if they weren't previously eligible, if somebody came in mid-year and let us know that there was they had a baby, or there was a divorce, or an increase in wages, that will affect eligibility for a PTC and the amount of that PTC. So these changes, as I said, it could be marriage or divorce, increases or decreases in the number of dependents, a change in an individual's residence, etc. All of these things can affect the amount of tax credit that somebody is eligible for. So actually, I'm sorry, we were going to stop and take some questions before we moved on to this next section. And I think I've got a bunch here. For exemption based on advantage. Okay, so for customers who were uninsured for just under the 3-month limit, they should not need to file an exemption. They will, when they receive that, we're going to talk a little bit about the 1095A that customers will receive, and it will reflect the number of months that somebody didn't have coverage for. So that's going to be an automatic exemption if it's less than, through the IRS, if it's less than 3 months. So another question that we had was if people who are 65 years old or older and do not qualify for Medicare, are they able to come through the exchange and get tax credits? And the answer to that is, if their income makes them eligible, then yes, they are able to do that. Okay, so hold on, I'm just getting some more questions. All right, so one question that came in that I'm actually just learning the answer to is about if the 8% cost exemption applies to the cost of a family plan or an individual plan. And in this particular case, it applies to the family plan. Whereas with the 9.5%, you're probably all familiar with the fact that that applies to the individual plan. So there is a difference between those two things. That's a good question, and I'm glad to know the answer. Okay, so the next question here is if an individual is eligible for an APTC and takes the full amount in advance, can that individual decide to reduce the amount of APTC they take at any certain time during the year? So I think the question is basically asking if I'm a customer who applied, let's say I applied for January of this year and I took 100% of my APTCs and decided maybe in March or April, you know what, I'm feeling like I'd rather only take a portion of it, that I'd rather pay for more of it up front, yes, you can reduce the amount of APTCs that you're getting during the year. Yeah. Sorry, I'm reading the question and making sure I understand it. Right. So the question is, if a client was on a QHP and after filing taxes are Medicaid eligible, will they receive a tax credit? Yeah. So I guess it depends on when we're talking about their income might have changed. Okay. All right, that's what I thought. All right, so the question, I'm going to say the question again because it took me a minute to get the answer, but if a client was on a QHP and then filed their taxes and found that really they should have been on Medicaid based on what their end-of-year income is, they will not have to pay back the tax credit that they received because there's a hold harmless, so that they will not be required to pay that back. All right, we're gonna when we send out the questions and answers, I think we're going to give a little bit more information about what a customer in that situation can do. But the bottom line is that they will not have to repay the tax credit. So, Rachel, how are we on questions? Should I continue on, or should we? Okay, so another one that we know that we have another couple of questions that we're working on right now. I'm going to keep moving forward, and we'll come back to those questions once we have a definitive answer. So, the moment you all have been probably waiting for, the 1095-A. So this is the form that customers will receive to give them the information about what they received for tax credits, or maybe didn't receive if they chose not to take them ahead of time for a given year. It is issued by HealthSource RI and will be sent out to all QHP enrollees regardless of whether or not they actually took that APTC during the year. We don't want to make an assumption that somebody wasn't due for a tax credit. So we'll send it to anybody who is enrolled in a QHP. It will be sent out by January 31st, and it's going to show a number of things. One, it's going to show documentation of coverage by month and family member. Two, it's going to show premiums of coverage selected. Three, it's going to show premiums for the benchmark plan. And what we mean by the benchmark plan is that's the plan that is used to determine how much APTC each customer is eligible for. And it's also going to show the amount of APTC that somebody received if they received it during the year. Generally speaking, there will be one form per household. The exception to that is if in a household there are more than one health plan selected, then they'll receive however many health plans. They'll receive 1095 per each health plan. So it's not going to be a very common thing, but some households may receive more than one 1095-A. There will be no 1095-As generated for the catastrophic plans or for employer-sponsored coverage that's purchased through HealthSource RI through our SHOP program, our small business program, because these plans are not eligible for tax credits. There will be no 1095-A form generated for Medicaid enrollees. And once distributed, if somebody loses a copy or wants an extra copy, they can absolutely go to their own account on HealthSource RI and get a copy of a note. It'll be in their Notices tab. They'll have a copy of the 1095-A, so they can print down as many copies as they feel they need. Additionally, the IRS will get a copy because they'll need to have something that they can reconcile what a customer is submitting. They are not available yet, and so we know it's likely we're going to start getting some calls. We've sent out a Watch the Mail letter on Tuesday of this week to let people know to expect these, but they will not. If a customer calls and asks for it early because they want to file their taxes early, we can't accommodate that. The Watch the Mail letter, as I mentioned before, does explain what Form 1095-A is and the importance of waiting for it before beginning the 2014 federal tax filing process. If they file their taxes before they get their 1095-A, they're just going to have to refile again. A couple of did you knows that we decided to include because we found them through research is that a lot, and maybe you already know this, but a lot of low and moderate income filers will typically file very early in the tax season because they want to obtain those refunds. And a majority of those refunds are typically between $2,000 and $3,000, and oftentimes that is the largest paycheck of the year for a number of families. So it's really important that people understand, the ramifications of if they didn't give us the correct information, how that may affect what their refund check might be. And also just an FYI for customers that February is peak filing season. Actually, February 15th is the heaviest filing day of the year. So here's just a snapshot of what the Watch the Mail letter looks like. It's not the entire letter. If we tried to put the entire letter here, it would be illegible. But we have a feeling that some of you may have people coming to you and with this letter saying, what is this and why do I care about it? Just so that you all have visibility to what that letter looks like. And as I mentioned before, these letters will be available in customers' accounts as well. So what should people do with the 1095-A form? There are a number of steps that we want them to be thinking about when they think about filing their taxes and how the 1095-A form affects the filing of their taxes. And the first step is that they want to collect all of their tax information, including this form. They should use this form and any final tax data from their 1040 to complete the 8962. So customers can't actually just attach the 1095-A that we're sending out to them to their taxes and send that into the IRS. They'll need to use information from the 1095-A to populate the 8962, and they're going to be doing a calculation on their own to see how much they received in tax credits, which is what we're telling them in the 1095-A, and what they actually should have received based on their final income that they make for the year. And then step 3 is that there are 4 possible outcomes that customers will see from the on their federal tax return, and we'll look at what those are in depth in a moment. So that first step, they should check to make sure that the 1095-A looks right. And when we say looks right, really what we're focused on is, number 1, are the coverage months correct? So did the customers think that they were covered, they didn't apply maybe until May, and so they know that they had coverage May through December, but for some reason the 1095-A shows them as being covered April through December, and they don't believe they had coverage in April. So if that to them looks like an error, then they should absolutely contact us. Also, are the covered individuals correct? So if anybody in the household they believe should be covered has been covered, are they listed on the form? And does the monthly premium look right? But this one has a caveat. It will not be an exact match. So if a customer says, well, I know that every month I was paying $372 for my premium, but on the form it says $368, that is not an error. And the reason for that is because for the premium, for the purposes of filing an APTC, that premium amount is going to be reflective of the essential health benefit portion of a premium. So it's not the entire premium, it's almost the entire premium. But that number may, if people are really paying attention to it, it may look slightly off. If that's the case, it isn't an error, and you can let customers know, nope, that's not an error, that is the correct amount. So a little more depth about step 1. So if Form 1095-A does have incorrect information based on what we just looked at for the coverage months or family members covered, they should absolutely call HealthSource RI. There is a number here. It's going to be on the letters. It's going to be on our website, so it will be a very visible number for people to call. If they think their monthly premium is shown as wrong and it's other than that small difference that I just referred to for the EHB portion, then they should contact HSRI. Assuming that Form 1095-A looks good, then the enrollee should proceed to step 2 and utilize the 1095-A information to complete that 8962. And I'm sorry, I feel like I'm speaking in code here with all these different numbers. But these are the different forms that customers are going to be needing to use. Here's just a quick example of what the 1095-A looks like. This is what customers will be receiving from us at the end of this month. It lists in Part 1 the primary account holder, and a spouse if they have one on the account. And then Part 2 lists any dependents who are covered in the household. Part 3 is where we're looking at the coverage months and the premiums and the APTC that people got. So in that first column, it shows the months, and obviously that we're not going to have, not all customers are going to show every month of coverage there because not everybody was covered for all 12 months of the year. Column A is where they'll see that premium amount, and that's where that amount is going to be a little bit different maybe than the premium that they were paying each month or that they saw that was on their bill each month. Column B lists the second lowest cost silver plan. That's that benchmark plan that I mentioned before, which is what the APTC for all customers is based on. So that plan will be listed there as well. And then column C is all of the tax credits that the person received by month. So this information they will be using to fill in their 8962. So as I mentioned before, if they believe that the information on 1095A is incorrect, they should call HealthSource RI, and they should call us with the tax-related inquiries specific to the 1095A. We will not be equipped to be answering questions just about tax filing. We can help you guys refer people to tax filers and such, but that isn't something that HealthSource RI is going to be doing because it's really outside of our scope and our abilities. There will, however, be a very clearly well-trained staff available to talk to customers about their 1095A and any questions they might have in reference to that. It is really likely, and we're hoping you guys can help if you're speaking to customers, it's really likely that when customers call with questions about their 1095A, it's going to take some time to research. So it may not, the questions that they have may not be finalized while we're on the phone in that 5-minute conversation with an enrollee. So we want to make sure that the expectation is clear with customers that we will work with them, we will talk to them, but it isn't necessarily always going to be a very quick, easy thing to have a solution to. It may require some research on our part. But of course, we will do that as quickly as possible and certainly call the enrollee back to let them know what the outcome is. Yeah, so if the form is incorrect and we determine that it is incorrect, we will create an amended 1095A form that will be provided to the enrollee. We will let them know, but if you would like to let them know as well, if they're asking for us to make a change and we determine that there is a change needed, they should wait to file their taxes until they get that amended form. It will make it a lot easier for them. And just a little caveat here, to protect the privacy of our enrollees, we can't talk to tax preparers. We have to talk to the customer specifically. They can certainly be in the room with their tax preparer if they'd like to and put them on speakerphone, but they have to be on the phone for us to have a conversation with them. And again, they should be clear with their tax preparer that they can make a call to us and help ask questions, but we will likely not be able to come to a conclusive answer in a 5-minute conversation. Okay. Step 2, the enrollee, or more likely their tax preparer, will utilize the information in that 1095A and from Form 1040 to complete that 8962. And that's where the rubber kind of hits the road. It's when it's going to show what their actual tax credit was due. And it's really important for customers to understand that if an enrollee receives an APTC or wants to claim a credit, they can't use Form 1040EZ. Some of these customers may have only ever used 1040EZ. If they claimed a tax credit during the year in advance, or if they want to claim a tax credit now when they're filing, they can't use the 1040EZ. Let's take a really quick look at what the 8962 looks like. My apologies that it's not all that legible, but this is basically, it looks like a lot of other tax forms out there. This is basically what's contained within it. And you can see the different lines there. There are different parts, and let's just talk about what those different parts are. Part 1 asks for the annual and monthly contribution amount. Part 2 will talk about the PTC claim and reconciliation. Part 3 will show any repayment of excess of advance payment if a customer received more than they should have or is due some. Part 4 shows the shared policy allocations, and Part 5 is alternative calculation of marriage. I would go into depth with this, except that I am not an accountant and I'm not as familiar with Form 8962. But it really is important that customers are making sure that they're telling any tax preparers that they were utilizing HealthSource RI and that they have the 1095A so that tax preparers know to be using Form 8962. Okay, so I think we're going to stop for a second, and I think we have a bevy of questions here. The tax info line. Okay, so there was a question about the number for the tax info line that's in the presentation. It sounds like maybe there was one slide with an error. So we're going to correct that slide and make sure that the number is consistent throughout. It is correct in the letters that customers will be receiving. So it's the number, if you've written it down and want to change it, is 855-408-1344. But as I said, we'll correct it in the slides and make sure that that goes out correctly. We had a question about if taxpayer on a payment plan, it can be on a payment plan with the IRS for back taxes. Will their possible refund be used to offset the amount owed to the IRS? Unfortunately, that's very much a tax-related question, and I would be misspeaking if I claim to know the answer to that, but it's a great question for a tax preparer or the IRS. Okay, so families on rideshare, are they going to receive the 1095A form? They will not. Only people who bought coverage through HealthSource or I and got a tax credit or purchased a commercial plan and didn't take a tax credit will get the 1095A. So anybody that was on any type of Medicaid, whether it be rideshare or anything else, will not receive a 1095A. Those families, if they're filing taxes, will just need to check the box to indicate on their 1040 to indicate that they did have coverage. Good question. Will HSRI clients be able to continue to file electronically for federal and state returns? And the answer is yes. But again, they can't use the EZ form. But they can actually use any tax filing software online and do it that way. It should very clearly walk them through any of the information required for proving that they had health coverage or if they got any tax credits. Do we have any other questions before I move on to the next section?
Hi, we just have one more. For our clients who filed their taxes on their own, what will happen if they file the 1040EZ and receive a tax credit?
The form will likely be, their tax return filing will be sent back because the IRS will have a copy of the 1095A from us showing that they did receive a tax credit. So it will be, I don't know whether they'll reject it flat out. I'm not sure exactly how the IRS will deal with it, but you'll need to refile a full 1040. You can't, if you received a tax credit, you can't use the 1040EZ.
And that would be true if they went through a TurboTax kind of?
That's right, yeah. So even if they filed electronically and used the EZ form, then same thing. No matter what the avenue was they took to file their return, if they filed an EZ, a 1040EZ, and did receive a tax credit, it's going to be sent back to them.
Okay, that's all we have for right now.
Okay, so I mentioned before that there were 4 possible outcomes that could happen for a customer who files the 8962 with their taxes. And so let's just dive into those now. The first one is that the APTC equals the PTC. So there's the net change to the taxpayer is 0. We are thinking this is a pretty unlikely scenario that somebody would be able to estimate their actual income at the beginning of the year down to the dollar. So I will eat my words, I'm sure, if I say that nobody will receive this, but there probably won't be, it definitely will not be a vast majority of people. The second scenario is where the APTC that a customer received is greater than the PTC. So in other words, I received more each month than I was actually due. When I fill out Form 8962, I determine I should not have received as much. So the taxpayer must pay back the excess tax credit, subject to the repayment limits, which we're going to look at in a minute. That excess amount will either reduce a refund that the customer is due, or it will be added to any amount that they would otherwise owe to the IRS. The next outcome is if the APTC they received during the year is less than the PTC that they're actually due. in this case, the taxpayer will receive the amount of a credit either through a larger refund or it will offset any amount that they would otherwise owe to the IRS. And then the final outcome is that the APTC was not requested, but the taxpayer is owed. So for a customer who either decided not to take it at all, or maybe a customer who decided they didn't want to ask for a tax credit, they didn't want to ask for assistance when they applied, but now decides that they'd like to, and sees that they're due, they will receive the amount of the credit either through a larger refund also, or to offset any other monies they may owe to the IRS. We want to focus specifically on that second outcome because we think that that is the majority of the people you'll be hearing from. And this is where somebody's APTC was greater than the PTC that they were actually due. We have a feeling we're not going to be hearing a lot from people who are in the opposite scenario, where they're getting back more than they expected. We think the most questions will be driven out of this. So for example, if somebody was found eligible for $4,000 in tax credits in advance, but when they calculated their PTC on their 8962, they discover that the amount that they made at the end of the year is different than what they projected, and they received maybe $1,000 more than they should have, then they would need to pay back $1,000. And again, that would either be would be taken from a refund that they're otherwise due, or they would need to pay that if they owe anything to the IRS. Remember that a tax return must be filed to reconcile APTCs regardless of any other filing requirements. So for customers who had very low income but maybe weren't otherwise eligible for Medicaid and so got a QHP with APTCs, they have to file tax returns. And the amount that's on Form 8962 is what would be entered on Form 1040. So is there a limit to the amount a taxpayer can owe to the IRS? And the answer is, in most cases, yes. For individuals and families with incomes below 400% of FPL, they're protected by repayment caps. However, if a person's income is above 400 FPL, they discover that at the end of the year, then there are no repayment caps, and they'll have to pay back the entire amount of APTC they received during the year. This is just a chart to show you what those repayment caps are. So you can see if somebody is, their income makes them less than 200% FPL, then if they're an individual, they don't have to pay any more than $300. If they're a family, they don't have to pay any more than $600. Even if they took $1,000 worth of tax credits more than they should have, they would stop at one of those two numbers depending on their situation. For 200 to 300 FPL, the individual cap is $750 and the family cap is $1,500. For 300 to 400 FPL, the individual cap is $1,250 and the family cap is $2,500. As I mentioned before, the 400% or more FPL, there is no cap. So let's just look quickly at an example for the repayment caps. If we talk about an individual taxpayer, and so a household of one, if their FPL is 350%. If the total tax credit they received in advance was $2,952, but when they fill out their 8962 with their actual income earned, they discover that they should have only received $1,062 in APTCs. There's a difference there of $1,890. But because of that individual cap for people between 3 and 400% FPL, their cap is $1,250. So they would have to pay up to $1,250, but they wouldn't have to pay the difference between that and the actual amount that they took. And again, that amount will be deducted from any refund that they're due, or it will be added to any amount that they owe to the IRS. So let's just talk a little bit about how we can help customers filing taxes, because we know that for some people this may be the first time they're doing it, maybe the first time they're not using the 1040 EZ. It's certainly the first time that they're obtaining tax credits for health insurance. So we absolutely understand and acknowledge that this may be a little bit confusing, and so we want to be as helpful as possible. That in mind, we cannot at HSRI provide tax preparation assistance, and we cannot provide tax advice. We will, however, really encourage our enrollees to work with qualified, experienced tax preparation professionals. And through research, we've discovered that a number of our enrollees actually have existing relationships with tax preparers. So we'll certainly encourage them to utilize the relationships they already have. If a customer comes to us and says, I don't have a tax preparer, we'll definitely recommend that they talk to family and friends and ask for a referral to somebody. And as we talked a little bit about before, they can definitely use any tax preparer software. So TurboTax or anything like that that they're used to maybe using will have the information loaded in there. They just need to make sure that they're using the full 1040 form and not the 1040 EZ. We will certainly encourage them to select the tax preparers really carefully to make and ask questions about whether this preparer is familiar with the health insurance tax credit and the shared responsibility payments and exemptions. In addition to this, HealthSource RI is going to be providing an email address for tax preparers. So just to be clear that this is not meant for consumers, but for tax preparers, they can send us questions to this email address. And we're going to create an FAQ list that will be updated very frequently. We will not be responding to individual questions from tax preparers. We definitely don't want them to be asking us questions about specific consumers, and they shouldn't expect a response, but what they should be doing is checking the FAQs frequently, and they will see their questions reflected with the answers there. We also will help people understand that there are free tax return preparation services available. Some of you may be familiar with the VITA program, the Volunteer Income Tax Assistance Program, which offers free tax help to people who generally make $53,000 a year or less. They also assist people with disabilities, the elderly, and people with limited English skills. And they help them with preparing their own taxes. They are IRS certified volunteers, and they provide that basic income tax return preparation with electronic filing for qualified individuals. Additionally, there's the TCE, the Tax Counseling for the Elderly program, and this offers tax help for all taxpayers, but particularly those who are 60 years of age and older. Please make sure that if people are asking you about this and you're referring people to one of these two options, that they are clear that they're not actually available until January 20th, because this is the first day that the IRS will accept electronic returns. So they do not allow for these programs to start working with customers until that date. And for a list of those sites, it'll be available soon. They don't want to publish that too far in advance because they don't want people going to it before January 20th. But the website here is the link that they can look up. I think, is it going to be on the HealthSource RI site? Yeah, so we'll also have a list on the HealthSource RI site probably in the next week or so. And it'll be sent out with the materials, maybe not with the materials, but subsequent to the materials from this webinar today. And there's also a phone number there that you can call. Obviously, there are paid resources available. So other avenues that customers can utilize would be using a CPA who does taxes. The retail tax prep firms, H&R Block, Jackson Hewitt, Liberty Tax. HealthSource RI is in communication with those folks so that they know that they'll be able to use that email address to ask us questions. There are also independent tax preparers and, of course, the tax prep software, so anything that you could use online. So finally, I'm not going to go through all of these, but there are a number of excellent resources out there that you can use to further educate yourself or provide to customers. The healthcare.gov is a great site for this and a number of other things. The IRS.gov section about the Affordable Care Act is robust and has a lot of information. There's definitely information in there that is helpful for tax filing purposes. And then there are additional resources here. I'm being told that the best one that is available right now is that first one in green, the Healthcare Law: What's New for Individuals and Family. I've read through it and am definitely not a tax professional, but found that it was pretty much easy to read and very, very informative. And then some additional resources are that we're going to have an FAQ section on our site. Actually, I think it's up as of today, and will continue to be filled in with information as it becomes available. And as I mentioned before, as we get questions in that we are able to answer, it will be updated with that information. And then the final one here is the Center for Budget and Policy Priorities, just another resource for people to utilize to help get information. So I think, let's see, questions, yeah. Okay. Yeah, okay. So one question that came in was, what happens to a tax credit eligible person when a spouse reaches 65 and is now participating in Medicare? So a customer should report that change through their account, or they should call HouseSource RI, and they should only now be covering the non-Medicare spouse. However, the spouse now obtaining Medicare does still remain on the application, and their income still is counted as part of the household, so that's something to keep in mind. So the cost of the insurance will likely change because now only one person is being covered, and the tax credit amount will likely change too. It's really important to, as I'm sure you all know, to be reporting this and other changes to family size, family makeup, income size, anything like that. Okay, so how does someone over 65 get coverage through HouseSource RI? We've been told that they can't or not eligible for it's Medicare. So if somebody is receiving Medicare, they are not eligible. That is true. However, as I mentioned before, if a customer is over 65 but isn't eligible to receive Medicare, then they would fill out an application just the same as anybody else. And the eligibility should show that they are not receiving Medicare, and so it should provide them with tax credit eligibility if their income and family size makes them eligible. Does a 65-year-old get a tax credit if they are a dependent in taxes? Okay, so if a 65-year-old is claimed as a tax dependent, for example, adult daughter claims mother, and the daughter buys through HouseSource RI, it's the daughter who is eligible for a tax credit to help buy insurance. So if the mother is getting Medicare or Medicaid, the insurance the daughter buys will not cover her. If the mother is not covered and is insured with her daughter, it's still the daughter who files the taxes. So yeah, it'll be based on the daughter's filing in that example, if they're claimed as a dependent. So if a client doesn't file taxes, so this question is, yeah, will they be sanctioned from receiving future tax credits? So we believe the answer is yes, although the IRS hasn't issued any official guidelines on how these sanctions will be implemented. But the rules are clear that you must file a tax return if you receive an APTC. So the answer is probably yes. We just haven't gotten the final word from the IRS. I think that's all the questions, so I will throw it back to Rachel.
Great. Thank you so much, Carson. I know this is a lot of information and a lot of confusing and complicated information, but we really appreciate you coming and giving us as much of it as we could do in an hour and a half and answering some questions. Certainly, we will continue to provide resources and try to answer questions for folks going forward. I just wanted to highlight a couple of resources we have at the Health Coverage Project. As she said, we have exactly 1 month of open enrollment left, so we would love for folks to help get the word out to get people covered for 2015. We have a bilingual flyer on our website, and we also have some small photos to share on social media to just help remind folks that this is the time to get enrolled for 2015 so they don't face those tax penalties going forward. And then finally, just keep up to date with us. If you're not already receiving our e-news, sign up for it, and we will provide more information going forward. We will send out a link to this, the recording of this webinar, as well as the slides and other fact sheets and materials about the VITA sites and anything else we have going forward. So stay in touch with us, and thank you all for your attention today.